You know that feeling when you look at your brokerage account, see everything going parabolic, and think, Warren Buffett has been real quiet since I started trading? Yeah, well, this week the universe decided to humble us a little bit. Suddenly, those infinite green lines are showing cracks. Nvidia stumbled 6% in a week, and the Mac 7 started looking a little shaky. And as a result, that feeling of being a financial genius instantly turns into that sinking feeling in your stomach where you realize you're just the exit liquidity for a hedge fund manager's new yacht. For the last year, AI investing hasn't felt like finance. It felt like a cheat code. If a company even whispered the word algorithm in a press release, the stock chart looked like a SpaceX launch. You could throw a dart at the tech sector and accidentally make 40% returns. But if you've been around markets longer than a goldfish's memory, you know that when things feel this easy, that is usually when the exit doors get locked. So, the trillion-dollar question everyone is asking while they stare at their red screens this week: are we watching the first cracks of a massive AI bubble bursting, or is this just a mild sale before the robots take over the economy completely? To answer that question, we have to ignore the vibes and look at the one thing hype is allergic to: the receipts. Every financial bubble in history starts the exact same way. Not with a lie, but with a really good story. Except if you're talking about tulips, of course. In the late 90s, the story was the internet would change everything.
Developers. The key to .NET, the key to industry transformation, the key to success is developers, 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 developers. Developers, 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 developers. Yes!
And here's the kicker: the story was true. The internet did change everything. But if you bought pets.com, you didn't just lose money, your portfolio got taken out back and deleted, absolute zero. And then in 2008, the story was housing prices will never fall nationally. They did in fact fall, and quickly. Today the story is, code isn't just code anymore. It's a super intelligence that will cure death, colonize Mars, and write your emails. And Wall Street is absolutely addicted to that story. It's why every CEO mentions AI approximately 400 times per earnings call.
AI, generative AI, AI is AI, it uses AI to bring AI.
They know if they stop saying it, the stock price goes on life support. It explains the FOMO. It explains why you're awake at 2 AM googling if you should mortgage your cat to buy more semiconductor stocks. The bubbles happen when the price of the story runs a marathon while the reality of the business is still tying its shoes at the starting line. This brings us to the scary part, the part the bulls don't like to talk about. Let's call it the money furnace. Right now, big tech, Microsoft, Google, Meta, Amazon, is spending historical amounts of money. We are talking about hundreds of billions on GPUs, cooling systems, and energy. To give you context, in previous tech cycles, companies built software. Software is relatively cheap. You write it once, you sell it a million times. But AI isn't just software, it's hardware, it's heavy industry. It requires building power plants just to keep the servers from melting. This creates what Sequoia Capital calls the $600 billion question. To pay back these insane investments, AI companies need to generate $600 billion per year. And that's the thing, is AI generating $600 billion in productivity gains right now? I don't think so. So if you build a factory that costs $1 trillion and it produces extremely high quality lemonade, you're still going to go bankrupt. And there are also hidden traps like depreciation. Unlike buying land or a building, which keeps its value generally, an AI chip is like a used car. The chip you buy today for $30,000, in 4 years it will be e-waste because the new chip will be 100 times faster. So these companies are running on a treadmill that is set to maximum speed. They have to earn the money back immediately before their hardware becomes obsolete. And right now, I don't really see that happening. The revenue is mostly coming from people paying $20 a month so they can execute their questionable prompts and weird financial constructions between these AI companies themselves. If that revenue gap doesn't close soon, those billion-dollar data centers stop being assets. They just become the world's most expensive fan noise. Before we get into the case of bulls, let's also talk about the market structure problem. This isn't just about AI, it's about how the entire stock market is currently wired. You've heard of the Magnificent Seven. They are currently carrying the entire US economy on their backs like a gym bro trying to impress his dad. If you remove these 7 companies, the S&P 500 has barely moved. The other 493 companies are basically watching from the sidelines eating popcorn. This creates a concentration risk. Because everyone buys index funds and index funds have to buy the biggest winners, we get a self-fulfilling prophecy. It goes something like this. Money flows in, Nvidia goes up, Nvidia gets bigger, and index funds buy more Nvidia. It works great on the way up. It's a flywheel of joy. The flywheels work in reverse too. If Nvidia stumbles, say a 6% drop like we just saw, it drags the entire market down with it. It means that even if you think that you're diversified because you own an ETF, you aren't. You're basically a venture capitalist betting your retirement on 5 dudes in California. And to understand where this ends, we don't really need a crystal ball. We need to look at the ghost of Cisco Systems. Wall Street loves a picks and shovels trade. In the gold rush, you don't dig for gold, you sell the shovels. In 2000, Cisco sold the shovels for the internet. At its peak, Cisco was the most valuable company on earth. It had great margins and it had a monopoly. It was kind of a safe bet. But then reality hit. The demand for internet infrastructure kind of normalized after the dot-com bubble. The CEO of Sun Microsystems, a firm in the same industry as Cisco, roasted his own investors, asking them, "What were you thinking paying 10 times revenue for my stock?" Anyway, when the bubble burst, Cisco didn't go bankrupt. They are still a huge profitable company today, but the stock dropped 90%. If you bought the top, it took you over 20 years just to break even. And that is exactly the danger. You can be right about the tech, you can be right about the revolution, and you can still lose your shirt because you paid a fantasy price for a real asset. A great company at an insane price is just a terrible investment. The thing is, does anybody even know what's insane and normal anymore? Okay, I've been very bearish up until now. So now let's flip the script. Why might I be totally wrong? Because there is a scenario where this isn't a bubble, it's a paradigm shift. Unlike 1999, these companies are essentially printing cash. Nvidia isn't selling hopes and dreams, they are selling a product that is sold out for the next 12 months. So the bull case is simple: margins. If AI allows companies to fire expensive humans and replace them with cheap software, corporate profits are going to skyrocket. It sounds kind of dystopian to me, at least for the workers, but for the stock market, it's very, very bullish. Lower cost plus higher output equals infinite money glitch. Basically a real version of that. In that case, we might be in the iPhone moment. When the iPhone launched, people thought $500 for a phone was insane. Now we pay $1,500 without blinking an eye because it basically runs our lives. Technology adoption follows an S-curve. It looks slow, then it goes vertical. If AI solves autonomous driving or personalized medicine, then today's valuations might actually look cheap in 10 years. It is entirely possible that we are in a bubble, the one that keeps inflating for another 3 years. And as the old saying goes, betting against a bubble is the fastest way to go broke. So where does that leave us? Is the bubble popping? Short answer, the expectations are a bubble. The technology is real. We are likely in a rational bubble. The shift is real, but the human psychology attached to it has gone off the rails. So what do? You don't need to time the top. You need a strategy that isn't just hope. And most importantly, zoom out. The goal isn't to get rich this week. The goal is to stay in the game long enough to benefit from the actual revolution, not just this hype cycle. Because remember, the market can remain irrational longer than you can remain solvent. Anyway, if you found this video useful or if you just want to survive the robot uprising with your wallet intact, just hit that subscribe button. Oh, and send this to a friend whose entire personality is currently Nvidia calls. Thanks for watching.